In this video, we're going to address the 7 most common financial mistakes that growing families make that keep them from achieving the financial goals. So as your life increases in complexity, right, your family grows, maybe your career is expanding and requires more time. Maybe you're building a business or starting a side hustle. The complexity of managing your financial life also grows in parallel and can get out of control. Building a household financial system is a difficult and complex undertaking. It costs you time, it costs you money, you make mistakes with your own money. So I'm going to show you in this video how to stop second guessing your financial decisions and gain clarity that you're making the right financial moves for your family. Welcome. My name is Eric Amzalag. I am the owner and head financial planner at Peak Financial Planning. We are a fee-only fiduciary financial planning firm, and we work with clients all over the country to help them make smarter financial decisions, build financial systems, invest wisely, and tax plan for their wealth. So stay tuned. In this video, we're going to be covering the 7 mistakes to avoid as a growing family. The first mistake we're going to address is accumulating too much cash. So Albert Einstein called the power of compounding the 8th wonder of the world. So the earlier something starts compounding, the bigger and better the results will be in the future. You're busy and that's okay, but the truth is, the larger that any piles of cash gets, the harder it will be for you to make decisions about what to do with it. Your psychology will end up being your own worst enemy. You'll be more paralyzed into inaction the larger the amount of cash that sits and piles up in your accounts grows. So I like to remind clients that the best is the enemy of the good. If you have money piling up in cash, the first thing to do is to move it to something slightly better. So currently, checking and savings accounts at most banks give less than 0.1% of interest. Simply moving money into a high-yield savings account through a bank like Ally Bank or Synchrony Bank can increase that yield to as much as 4%. Money market funds are also a good option these days. You can find those using brokerage accounts at Charles Schwab or Fidelity, and those money market funds can yield upwards of 5% interest. While high-yield savings accounts and money market funds are great temporary options, they're not your long-term solution for the majority of your money. They can function as permanent homes for a small percentage of your wealth, but only temporary landing spots for the majority of your funds. The second mistake you need to avoid is not having an expense tracking system. All right, so no one loves to hear it, but financial independence is all about cash flow. If you overspend in the early years of your retirement, you increase the risk of running out of money while you're alive. If you overspend before retirement, then you run the risk of not having enough money saved up for your goals. So this is a train wreck that you can actually avoid just by having a system to track your spending. I'm not talking about a budget where you set limits to spending based on categories, although in some cases, that's probably the right move. I'm actually just talking about a system or even really just a tech tool that allows you to track how much you spend each month, broken into 2 categories: fixed expenses and desired expenses. Tracking your spending is going to allow you to increase how much money you save each month or each year, and every dollar that you save becomes a dollar that you can invest. Savings leads to more investable dollars. Like, that's the most important takeaway you can take from this. Savings leads to more investable dollars. The earlier you begin tracking your expenses, the easier it is to identify how much you're truly saving currently, the easier it becomes to plan how much you can save for future goals. And then the easier it becomes to adjust your savings patterns if you need to, so you can actually, meet the funding goals you desire. Financial mistake number 3 is not telling your savable dollars exactly where to go. What we're talking about here specifically is setting up funding goals. So Dave Ramsey always says, tell your money what to do instead of wondering where it went. If you don't have a plan for your savings, it will either get spent and say goodbye to your savings, or it's going to go to the laziest possible locations. Think back to the first mistake we talked about. Say hello to piles of cash in a bank account that you then don't know what to do with. The best way to prevent either scenario is to document your funding goals. So this can be really specific or it can be non-specific. So I'll show you an example on the screen here. An example of specific funding goals might look something like funding goal number 1. You have a car down payment requirement of $5,000 within 2 years. Funding goal number 2, a house down payment of $185,000 within 6 years. Funding goal number 3, kids miscellaneous needs, school, trade, business, whatever, of $30,000 per child within 14 years. Or funding goal number 4, having a total investable wealth of $2 million within 20 years. That's an example of specific funding goals. How do we change that for non-specific funding goals? Well, it really doesn't change that much. Let me show you on the screen. Funding goal number 1, money needed within 2 years, estimate of $5,000. Funding goal number 2, money needed within 6 years, an estimate of $185,000. Funding goal number 3, kids miscellaneous, an estimate of $30,000 within 14 years. And then funding goal number 4, retirement money, ambiguous, at age 65 of $2 million. You can see that the specific versus non-specific don't change that much. All we're doing is we just don't know what the exact goal will be. So you may not know that you'll need a car within 2 years or exactly how much you'll need to fund kids' education. The thing is, don't let that stop you from setting up these funding goals and sending your savable dollars where you tell them. Set targets anyways, and then rank order those buckets by chronological order. This will allow you then to use a financial calculator and an assumed rate of return, and then you can determine where to save those funds, how much money to save towards each goal, and how to invest those funds so that you achieve your goal dollar amount by the time you say you will. Without completing this exercise, we just default to saving in an aimless, directionless blob that, let's face it, just won't work out anyways. Financial mistake number 4 is only investing in your traditional 401k or your traditional IRA just because it's the easiest option. So tax-deferred investment options, that's your traditional 401k and IRA, are the worst form of savings. Yes, they give you a tax break in the current year, but at every point after that, they are far inferior to the other savings buckets. Taxes will be higher in the future, and the government wants you to pay more in taxes. That is exactly how traditional 401ks function. You avoid the tax now, but you pay the taxes on all the saved money and all the growth after age 59 and a half when you take distributions. Now, not only that, but money saved in traditional 401ks face penalties if you want to access those funds prior to age 59 and a half, with very rare exceptions. If you're a high earner and therefore a big saver, you need a more intentional plan for your saved dollars. That plan should address the future tax consequences of extracting that money. That plan should also address how accessible those funds are for shorter term goals, such as what we outlined in mistake number 4. So saving into a 401k or traditional IRA is better than not saving at all, let's be clear. But having a plan that saves the right amount into a 401k or a traditional IRA in conjunction with saving the right amounts into taxable accounts, Roth accounts, and high yield savings accounts is far, far superior. Financial mistake number 5 is buying a whole life insurance policy as an investment. So I have a longer video about this on my YouTube channel. You're more than welcome to click over there and see it, but the brief spark notes. Whole life insurance is often pitched as an investment alternative to traditional investment options, things like brokerage accounts or retirement accounts. Most of us know that whole life insurance is expensive, it's complicated to understand, and we know intuitively the person selling us the policy makes a sales commission off of it. But I still run into a ton of people who accumulate these whole life policies like Pokemon cards. Never makes sense to me. Whole life insurance is almost never good as an investment option. It's more expensive than temporary insurance, which is term life insurance, and you get far less death benefit from it than the temporary life insurance provides. On top of that, the investment portion of the whole life policy almost always underperforms against comparable investment options. So the question is, why is it so common? It's common because most financial advisors are actually insurance licensed, and they get huge upfront commissions for selling whole life products to unwitting consumers who are convinced by fancy policy illustrations and the prospect of security for their loved ones, all while the professional selling the product laughs their way to the bank. So I'll admit it, I have a bit of a bias against investment life insurance policies specifically. I will qualify what I just said by adding that there are some rare cases where whole life insurance can fit into an investment mix. They're few and far between and mostly reserved for the super rich who have already exhausted every other investment option arrayed before them. So that being said, I recommend 2 general rules to all prospects and clients I speak to who have been presented whole life insurance as an investment. The first is always seek the services of a fee-only fiduciary certified financial planning professional who is not insurance licensed to evaluate any policies that you may already have purchased or will plan to purchase in the future. You want someone who is not incentivized for or against the policy to evaluate it. Anyone making a commission on the sale of a policy will obviously be biased when presenting it. The second item is only consider whole life insurance as part of your investment mix if you've already exhausted all your other saving options and can still overfund the whole life insurance policy without pushing it into MEC status. MEC stands for Modified Endowment Contract. The thing is, if you don't know what that means, then the agent selling you the policy has both not explained it adequately, and you're also not in the position where it makes sense for you as an investment mix. You would understand those things already if it was a proper investment for you. Financial mistake number 6 is having undocumented financial wishes. So most couples have one financial driver and one financial passenger. Now, in most cases, division of labor is great. When it comes to your finances, there's a hidden price to division of labor, okay? If something were to happen to the financial driver, the financial passenger would have no idea how to execute on the financial driver's financial plan. Even if that couple were to have enough money to make it through the end of life, the financial passenger might be financially uneducated and therefore at the mercy of predatory financial services industry professionals. So documenting your financial plans and wishes, and I'm not talking about legacy wishes alone, although that is important, but I'm talking also about like the minutia, how much you save, why you save that much, where it's going, what's the tax consequence, why did you decide on this set of investments, and so on and so forth. Allows your partner to continue to execute on your financial plan without being taken advantage of. A documented financial plan acts as non-financial insurance for the passenger seat partner. Now, of equal importance, undocumented financial plans drift over time. Plans that lack firm commitments end up taking people down a long, winding road to who knows where. Documentation leads to commitment, which leads to decisive action, which leads to the optimal results. Last but not least, financial mistake number 7, not working with a fee-only fiduciary certified financial planner or a firm like Peak Financial Planning. So you can accelerate your timeline and increase your accuracy in achieving financial independence, especially if you partner with a fee-only fiduciary financial advisor that you trust and who has your best interests at heart. So that being said, I'd love to call to action. We'd love for you to consider working with our fee-only fiduciary certified financial planner team for the following reasons. We'll help you document your financial wishes and goals. We can help you create a reliable income stream that you understand and that's going to outlive you. We can help you pay the government less in taxes so you have more money to spend on the things that you care about. We can help you craft an investment strategy that you understand and it lets you sleep well at night knowing you'll be taken care of. So if you'd like to schedule some time to talk, you can use the link in the description to this video below. The consultation is free. We'd love to chat with you. If on the other hand, you're not ready to schedule a consultation or you're just in the learning phase, or you just want to learn more about what you can do on your own, that is entirely fine. We have plenty of helpful videos that help people in your exact position navigate their financial lives and build good financial systems on our YouTube channel. That's Peak Financial Planning on YouTube. And you can also visit our website at www.thepeakfp.com to learn more about how we work with clients, read helpful guides, and see our pricing and use sample financial plans, all that jazz. So if you've watched this far, thank you for your time and attention. We'd love to speak to you if we get the privilege. If not, good luck using our resources, and thank you for your time and attention. We'll see you in the next video.